Good day, fellow investors. One of the most requested stocks for me to analyze in our community tab is Foot Locker. And it's pretty clear why, as it is down more than 50% and many of you are now thinking or wondering whether this is value or not. If you look at the fundamentals, the price-earnings ratio is just 3.56, which is extreme bargain. The dividend yield 5%, which is significant, and now we have to estimate whether this price is value or a value trap. Of course, when you see a stock drop 50%, there have to be issues. We're going to discuss that. I think that in a general sense of things, Foot Locker at these prices is a buy, but I will explain the risk and reward, what you can expect, what's the best strategy to use if you want to go long Foot Locker now, and I hope this video gives you value. If you enjoy these kinds of analysis, smash that like button to support the channel with the YouTube algorithm, and also consider subscribing and smash that notification bell if you haven't yet. Let's start with the analysis. We'll do the business overview, what's going on, what is the key issue that's pushing the stock down. We'll look at the fundamentals, we'll make a stock valuation, and then conclude with a risk and reward investing strategy, and then you'll see whether this now is a buy for you, because only that matters. From a business perspective, we all know what Foot Locker is. They sell shoes, mostly Nikes, but now they have to diversify. As Nike went to more digital and more direct to customer, then also Foot Locker is under pressure, and that's exactly what's going on. And they also have to change their strategy because the old one didn't work that well, and now they are going for new strategies, different things, and that is the key when it comes to Foot Locker. And what is the key difference? Here you can see immediately one vendor is changing its strategy, that is Nike, and they do not expect one vendor to make 55% of total supplier spend, down from 65% in the fourth quarter of 2021, and even down from 75% in 2020. So 75% of sales were Nike, and there things are changing, which is disrupting for Foot Locker. So as we know, Nike going for more direct sales to consumers, and of course that will definitely impact Foot Locker. Plus there are other things with the business. Inventories are up 37%, so they might have bought a lot of Nike to have them in inventories. They say for supply reasons, but if there are supply issues, then your inventory isn't up, it actually goes down. So that is very, very interesting how that skewed there, but let's see how it goes, because this can also be an indication of issues to have inventories 37% higher than previous year. Of course, on the value side, there is almost $1 billion of cash. They have some debt now. They have taken a loan of $457 million, so that's also to conclude, but this is very important. The net cash position was $347 million compared to $1.6 billion last year. This means that they spent $1.3 billion in cash over the year, and that is very, very significant. They made some repurchases for $178 million, paid a dividend for just $25 million, invested into acquisitions, and paid down some debt. Capital expenditures around $270 million for 2022, and the key here, extreme value, is repurchase up to $1.2 billion of Foot Locker stock. $1.2 billion on a market cap of $3 billion, that is insane. That would be a buyback yield of what? 35% if the stock price remains where it is, and that is absolutely crazy. And that is the first thing that makes it a buy. If they spend $1 billion buying back their shares, and on this market cap, then it is a double or triple with the stock, no matter what happens else, because that's simply how buybacks work. But then again, the revenues will decline as Nike is going away. Also, the business model in the world now, the business models are shifting to more online, so less going to the stores, less foot traffic, no Nikes, no this, less sales, which can be detrimental for the long-term business. And there is something else when it comes to capital allocation. If we look at the latest two acquisitions they made, WSS and Atmos, then you can question their capital allocation strategy and whether they will have the money to do buybacks. Foot Locker has 3,000 stores and a market cap of 3 billion, that's 1 million per store. And then they go and make acquisitions, 737 million for 93 WSS stores, or 8 million per store. 360 million for 49, 7.3 per store. That is incredible when compared to what they have. So if they had spent this money on buybacks, the stock would have been a double already. So this is questionable from a capital allocation strategy. Let's look a little bit into the fundamentals, and this is the key with the Nike impact. Alright, revenues have been relatively stagnating, especially when you include the acquisitions. Then revenues are slowly and steadily declining. Earnings have been really good lately, but that's also stimulus and buying shoes, etc. Free cash flows have been very high, but the number you have to focus on is gross margin. 34%, that is higher than ever, and with Nike going on, with sales going down, this gross margin is expected to significantly drop, which means that also earnings will drop around $4.3 for 2022 expected, thus half of this, which also means that the cash flows will drop, and therefore also the valuations in the future will be different than current. Just a quick look at the balance sheet, and all looks fine here. We have our cash position very high here. The inventory is there also very high. If they can sell it, good, but depends on the price they are also selling it. There is goodwill after the acquisitions, so this is something to write off. I don't consider it as value, so 785 million off. There are operating lease right of use assets. That is just accounting. Whether you have them here or not is irrelevant. So lease term obligations on the other side, whether this is 8.1 billion or 5.5 billion, to me is irrelevant. But it shows that the obligations are there and this has to be paid. It is a cost. It's not an asset from a realistic business perspective, from an accounting. Yes, so this will come, this will be the cost. It's a pretty fixed cost, so if sales go down, gross margins will go down. Margins will go down too. But all in all, looks nothing spectacular, but okay. I've made a quick valuation for Foot Locker. You can find this intrinsic value template with many stock analyses in the link in the description below, free for download. And let's do the valuation. I have inserted the expected earnings per share here. I have included the present value of those earnings as value if they return them to shareholders on dividends and buybacks, but I have also included growth rates declining, so minus 10% for the first 5 years, minus 5% later, and expected return of 10% and terminal multiple of 10%, it gives an intrinsic value around the current stock price. If the slowdown rate is slower, then of course the intrinsic value is higher, but if things go really south with bigger declines, then there is plenty of room for down. And the problem is that the market hates businesses with declining sales, and we don't know what the environment will look like 5 years down the road. The competition is very fierce and we are buying less and less by foot and more online, and especially now with losing Nike, the whole business model is in jeopardy. That's the risk for sure. And now, is Foot Locker stock value or a value trap? Seth Klarman said in a recent letter, and we made a video on it, that value investments that have good fundamentals, low PE ratios, may fail to represent value if the underlying business is quickly eroding, turnaround seems unlikely, and the management is squandering money on wrong things. So we have a very low multiple, the business is eroding, and the question is how fast will the business erode for longer term investors, and whether it will erode slowly so that they can spend the money on buybacks or not. This is with Nike. Now with Nike gone, this will start to go down, and the forecast is for 10% down next year, as Nike is going away and going towards digital, and everybody else is also going towards digital. Therefore, is there a turnaround? Will they be able to replace Nike? The market thinks not. And also we have seen here that the management is squandering corporate cash because this is simply not good capital allocation, no matter what it looks like. They spent this $1 billion just to keep revenues stable so that it doesn't immediately look that the revenues are declining, which is a terrible way to use money. Here is the financial outlook. Comparative sales down from 8 to 10%, sales change down from 4 to 6% just because of the acquisitions. This is what we have to focus on. And then gross margin 30%. Remember the very high margin 2021 showed, which is about to change. And then also earnings per share 4.25, 460, so half of what it is now. Thus the PE ratio is not 3.5 but around 7, 8. And then on the buybacks, why are they focused that much on buybacks? They did buybacks and retired a lot of shares in 2021 and 2020, 5.4 million and 913,000. But then I just wanted to see a little bit more about that and went into the last SEC disclosure, and I have seen that under stock awards and share-based compensation, as of January 2022, there were 5 million shares for issuance under these plans. So of course the management wants stock prices to go up so that they can receive their money through stock options and these stock awards. So therefore always look at the incentive, and that's also what they are doing here. And also there is employee stock purchase plan, another 2 million shares, which is again higher than what they retired into the last year. Of course these incentives are in line with your incentives, but you must then buy and then sell, because if you don't sell and the business is eroding, then buybacks don't help over the long term. So is Foot Locker stock a buy now? From a buyback perspective, it's an absolute yes. I've made this video on the inelastic market hypothesis that explains Professor Gabai's from Harvard theory, where $1 invested in the market cap in buybacks increases the market value by 5. That is what Foot Locker wants to do. And if they put in 1 billion, of course the stock price should go higher. I think the market value will increase by 3 billion, so that is double. I'll put the link into my explanation, and even Professor Gabai contacted me, thanked me for the video, and said that finally his family understands what he does. That was a very nice comment from him. I'll put the link for the videos in the description below. Very important videos to understand. But from an investing perspective, this is pure financial engineering. But don't think it doesn't work. I made this video on Restoration Hardware almost 2 years ago, saying it is a buy and that it is a stock that must go up. The price was around 90. The price was around 90, and I said it is a stock that must go up. These guys were doing buybacks and borrowing money, issuing convertible stock to do that. Of course, the stock went up from 90 to 640, but at some point these financial engineering things stop working, and then you have this. So if you want to take advantage of this, then you have to go on the upside. And that's also the investing thesis with Foot Locker. I'll put the link in also for that video if you want to better understand the investment thesis there. However, is Foot Locker a stock to buy on business quality? Then there is a different story. There are structural risks to the business model. Nike going away, less people, different trends. We're going more and more online, so you can see everything, compare prices, sitting in your home, nice and cozy, instead of going there with the rush, with this, with that. So the traffic is declining, that's a given. Foot Locker was cool when I was a kid, it was wow, new thing, but now it's deteriorating. So from that long-term perspective, it is an issue. And I personally prefer to invest in good businesses with a structural tailwind where business will do good over time, and that limits my investing risks. So you have to see how this fits you. If you want to play this upside on buybacks that is extremely significant from current levels, keep in mind that further negative news might push the stock lower, but then again, shorting the stock, and when they start to do buybacks, if they have the cash, that's also the key, and if they do that aggressively, also short covering might push it up. So I expect high volatility for the stock. So also think about your exposure if you're going into Foot Locker. When it comes to strategy, you might also think about staging your purchases or option exposure or whatever, because it's for sure going to be volatile, but as it went down fast, it might also explode on the upside. And that should summarize this very, very interesting stock. It's not my kind of businesses. I am a longer term investor, so I hope I have given you value. If you are seeking this and if you're interested in Foot Locker, then I think you will value this. Thanks for watching. You might check what I do personally. Intel is an example. So see you in that video and also in the next video tomorrow.